Are you confused between investing in ETFs or stocks? You're not alone. In this video, we'll break down the key differences and help you decide what's better if you're just starting out. First, let's understand the basics. ETFs, exchange-traded funds, a basket of securities like stocks that you can buy or sell on a stock exchange. They track an index, sector, or theme. Example, Nifty 50 ETF. Stocks, shares of a single company. When you buy a stock, you own a small part of that company. Summary, ETF equals diversified basket. Stock equals one company bet. Why beginners prefer ETFs? Diversification reduces risk by spreading across multiple companies. Low cost, especially index ETFs with very low expense ratios. Passive investing, no need to track individual companies daily. Easy to buy, sell, traded like stocks on the exchange. Example, instead of picking 5 banking stocks, you can buy a banking ETF that holds them all. But stocks have their advantages too. Higher returns. If you choose the right stock, returns can be massive. Control. You decide what to buy, when to sell. Dividends. Some stocks pay regular income, but remember, picking stocks requires time, research, and patience. Investment composition. ETFs are like a basket of many stocks or securities. When you buy one ETF, you get exposure to multiple companies or sectors at once. Stocks, on the other hand, represent ownership in a single company. If you buy a stock, you're putting your money into just one business. Risk and diversification. ETFs offer automatic diversification, which lowers the overall investment risk. If one company in the ETF performs poorly, others can balance it out. Stocks carry higher risk because you're betting on the performance of one company. If that company fails, you may lose a big portion of your investment. Required knowledge. Investing in ETFs doesn't require deep research on individual companies. You can rely on the index or sector the ETF tracks. Stock investing needs more analysis, like studying company fundamentals, financials, and market trends. Volatility and stability. ETFs tend to be more stable due to diversification. Price movements are generally smoother over time. Stocks can be highly volatile. A single news event can drastically move a stock's price up or down. Active versus passive. ETFs are usually passive investments. Most track an index and don't require frequent buying and selling. Stocks often attract active traders and investors looking to time the market or pick winners. Cost and charges. ETFs have lower expense ratios and no fund management fees like mutual funds. They may have small brokerage charges when you buy/sell. Stocks also involve brokerage fees, but there's no recurring annual charge unless you subscribe to services or platforms. Time and effort. ETFs are buy and relax instruments. You don't need to track them daily. Stocks need more attention. You might need to monitor news, quarterly results, and industry trends frequently. Suitability for beginners. ETFs are ideal for beginners who want to start with low risk and diversified exposure. Stocks are better suited for those who can commit time to learning and are comfortable taking higher risks. So, if you're just starting, ETFs are a safer, easier option. But if you're ready to study companies, stocks can be rewarding too.